Hello, we are back, enjoying each other's company, right, Jeremiah?
Yes.
Yes, okay. I did a lot of talking last time, didn't I? Okay. We're going to actually be doing some work in class here, so you won't hear me lecturing as much as I did, thankfully, last time. But let's go ahead and go over the homework that I assigned. I believe I assigned kind of some conceptual quick studies that were probably pretty easy. Okay. So let me put the questions up there. I'll just put them for all of them. Okay. The ones we'll go over are this one, and this one. 1, 2, and 4. Okay? All right. You can come off that, though. You don't need to show it the whole time. Which one of the following sets of items are all necessary components of the main budget? Number 4, operating budgets, financial budgets, and capital expenditure budgets. Correct? Okay. That was pretty easy. Quick study 22.2. The motivation of employees is one goal of budgeting. Identify 3 guidelines that organizations should follow if budgeting is to serve effectively as a source of motivation for employees. Okay, we talked about this. One of the advantages of budgeting can be that it can be motivating, right? But what are some guidelines that we should follow for budgeting to truly be motivating? Someone want to give me one?
Participatory budgeting.
Okay, participatory budgeting, or sometimes we call that a bottom-up approach. Let people have a say in the budget that you're creating for them, right? Let them participate in it. Like I said, otherwise, if you don't ask their opinion, they have a built-in excuse. They can say, well, hey, you didn't ask my opinion. I could have told you this was not realistic, right? So people are more apt to follow a budget that they helped create. Okay, good. Another one.
Attainable goals.
You want attainable goals, right? You want attainable goals. For example, some of you will take managerial accounting next semester. What if you set the goal, I'm going to get 100% on every quiz and every test? Attainable. Is it attainable? It's attainable for you, Jeremiah, but most people it is not. Okay? Most people, besides Jeremiah, are going to fall short of that goal, right? But an attainable goal might be, I want to get an A in the class. I want to get at least 90% when it's all said and done. Okay? So you want goals that that can be reached. Okay? I'll give you a quick public service announcement. Okay? Put on my fatherly or my pastorly hat. One of the best things that you can do to increase your self-confidence, or if you are somebody who doesn't have good self-esteem, is the following. This will help your confidence. This will help your self-esteem. Make a goal, no matter how small, and accomplish that goal. Okay? If you do that, you will gradually get more confident. Now, they can be very small goals. Okay? For example, if you want to lose weight or you want to start exercising, don't make a goal that says I'm going to run 3 miles every day this month. You're probably not going to do that, okay? But even if you just make a goal that I'm going to go on a 1-mile walk today, if you go do that, at the end of the day, you will feel better about yourself, okay? This is good advice, okay? Make goals no matter how small. Maybe your goal is I'm going to spend 30 minutes studying accounting tonight. That's it, okay? And that small goal, if you do that, it will gradually increase your self-confidence and your goals will start to become larger as well. But we want those goals to be attainable, okay? Too many people set unattainable goals and they don't reach them, and then their self-confidence even gets worse, okay? So, good advice. All right, what's another aspect we should consider if we want our budgets to be motivating?
Careful evaluations with opportunity to explain failures.
Yes, very good, Matt. You want to give them opportunity to explain maybe why they didn't make their budget. Because there might be a very, very, very good reason why they did not make their budget. Okay? You know, why are your utility costs above budget this year? Well, it's because gas prices went up. Well, okay, that seems like a good reason. None of us set the gas prices, right? Or, you know, why did you take longer in this area than you should have? Well, we discovered a problem, okay? I think I got time for a quick example of this concept. I worked in public accounting in 1992 and 1990 through 1995, okay? Some of you weren't even born, okay? So I worked in public accounting in the early 90s, and one of the first things they did when you went on an audit is they would say, this is how much time you have for the audit. You have 40 hours to complete the audit of this company, and look at their books and see if you know, test these numbers that we're going to put out on financial statements to the public. You've got 40 hours. And then they would further break it down to say something like, you've got 6 hours to look at cash, 5 hours for accounts receivable, 4 hours for inventory, and so on. And they would talk about that budget. They practically stapled it on your forehead the first day, okay? And they always said, how you doing on budget? How you doing on budget? Okay? How you doing on inventory? Well, I've spent about, you spent 3 hours, you only have an hour left. You better get going. You better get going. Okay? Now, that was the situation in the early 90s. Well, actually the way my career worked out is I accepted the job here at the college, but I wasn't going to start until August. This was in 2004. So what I did is I called my old public accounting firm that I used to work for, because I had 6 or 7 months I needed to work before the fall semester started here at the college. So I called them up and I said, hey, I don't know if you remember me. Well, of course they remembered me. And I said, hey, do you want me to come work for you as an independent employee? I'll work through busy season. And they were very happy to do that because it was somebody they could bring in during the busy months and then they wouldn't have to lay off somebody or whatever. So I went on these audits and the first thing I asked for is, what's my time budget on this audit? What's my time budget for this audit? And it was a completely different atmosphere in 2004 as compared to 1994. They said, do the audit, do what you feel is necessary. It will take as long as it takes. Don't worry about the budget. Yes, there's a budget, but they wouldn't even show me the budget. They said, just do what you need to do. And that was the way it was. I couldn't believe it. It was such a different environment from what I had experienced in 1994. Well, what do you think happened in that decade to cause that seismic shift in the way that the accounting firms thought about budgets?
Mistakes.
Mistakes. Some specific huge accounting scandals. Anybody want to guess on what they were? Enron, WorldCom. You've heard of those? Yes. I think that was actually after, but that sort of a thing. Here's what was happening. If you've heard about the Enron scandal, and if you've heard about the WorldCom scandal, what had happened in some of these situations was that auditors were so pressed for time and they were getting evaluated on how quickly they could do the audit. So if they saw something strange that needed some more testing, what do you think they did?
Overlooked it?
They just overlooked it. Oh, I'm sure it's fine. Let me look at this one. This one looks okay. All right? And what was happening is they were maybe winning the battle, but they were losing the war. Arthur Andersen basically went out of business because their audits were improper. Here's the analogy. Let's say I'm a doctor, and let's say a patient comes in and for his annual checkup, and I'm taking a look at him, and I'm looking at his shoulder, and his shoulder has a strange mole that doesn't look quite right. I don't know if it's cancerous, I don't know if it's not. But it requires some more testing, but I'm in a hurry. Well, I'm sure it's fine. Let me look at this other shoulder. There's nothing on that shoulder that looks alarming. You're good to go. give them a pat on the back, and send them on the way. Would you want a doctor who did that? Or would you want a doctor who, if they see something that looks odd, regardless of the time or the money, we need to test that? Does that make sense? Well, that's what we have to do in the auditing, okay? So it's a totally different environment in auditing. And I found in 2004 they did give reasons, or they did give ample opportunity to explain overages. Okay? All right. It's a long story, but I hope you enjoyed it as much as I enjoyed telling it. Okay, questions on that? Let's take a look at Quick Study 22.4. Good management includes good budgeting. Explain why the bottom-up approach to budgeting is considered more successful than a top-down approach, and provide an example. Well, we've talked about this. It allows people to participate in the budget creation, and they are more apt to follow a budget that they helped prepare. And an example would be perhaps if you, a sales manager sat down with their salespeople and helped create budgets for the upcoming year. All right? So, okay, questions on those 3 conceptual quick studies? 1, 2, or 4? Anybody? Okay, let's take a look at the next one. I think I assigned Quick Study 22, 23. Is that right? So let's take a look at that. Quick Study 22, 23. This is a pretty easy one, okay? Let's take a look at that. Score Inc. is preparing its master budget for the quarter ending March 31st. It sells a single product for $50 per unit. Budgeted sales for the next 4 months follow. Prepare a sales budget for the month of January, February, and March. Okay, now remember, when you do a master budget, the sales budget is the first budget that you prepare. Did we talk about that? Because all the other budgets flow from that. So the sales budget is the first one that you want to prepare. Now remember what I said last time. This is not always about computing a number, but also how do you show the computation of that number? How do you communicate that? Okay? So here is the way they came up with it. Okay? Did anybody get something like, kind of like this? Okay? Where you showed for each month, you showed the budgeted unit sales, the budgeted unit price, and thus the total sales for each month, and then the total sales for the quarter. Okay? Now, once again, that is not a sales budget, okay? That's just a computation of a number. This is a sales budget. We prepared it in proper form, the name of the company, the name of the budget, and the time period, just like your financial statements. But this is so much better because what if you said, well, hey, in March we might raise our unit price to $51. This would be very easy to tweak this sales budget to derive a new estimate for total quarterly sales, wouldn't it? Okay? So a large part of this chapter is starting to just think about how you're going to communicate this information. All right? Questions?
Is it important to show the totals?
Yeah. Right here? Yeah, you want to give the totals. Okay. Good question. All right? Okay. Next question. I wanted you to do that handout. Let's take a look at this. Let's do the down under question first. Okay? Is that focused? There we go. All right. I was thinking my eyes were going bad. Okay. Down Under Products has budgeted sales of its popular boomerang for the next 4 months as follows. You can see the sales in units. The company is now in the process of preparing a production budget for the second quarter. Past experience has shown that the end-of-month inventory levels must equal 10% of the following month's sales. The inventory at the end of March was 5,000 units. Prepare a production budget for the second quarter. In your budget, show the number of units to be produced each month and for the quarter in total. Okay, now whenever I see this verbiage of the end of the month inventory levels must equal 10% of the following month's sales and the beginning inventory is this, then we're going to have that situation where we derive it. And we talked about that last time, right? Okay? We start with beginning plus what comes in minus what goes out equals the end. Then we define it for this problem. And for this problem, it's beginning inventory plus production minus sales equals ending inventory. Then we write it horizontally. Beginning inventory plus production minus sales equals ending inventory. Circle the item that they're asking us to do. They're asking us to do a production budget. Rewrite this equation and isolate that variable. So production equals ending inventory plus sales minus beginning inventory. And then flip this so that production is on the bottom, okay? So let's take a look at the answer, all right? Okay, first of all, you can see the basic format of the budget. Now they do a little different verbiage, but it is sales plus ending inventory minus beginning goods inventory equals required production, right? Now they did a subtotal here, okay? Now let's go ahead and take a look at April. Well, they told us April sales, correct? We added the ending inventory. Now that should be 10% of the following month's sales. So May's sales are 75,000, is that correct? Is that right? Okay, so 10% of 75,000 units is 7,500 units. And I believe they told us the beginning inventory, or they told us the inventory at the end of March. Well, March's ending inventory is April's beginning inventory, correct? So required production in units for April is 52,500. How many people got that? Raise your hand. Okay, all right. Now we do the other months the same way, okay? We do the other months the same way. And of course, I'm pointing out that April's ending inventory becomes May's beginning inventory, and so on, okay? But each one of these numbers is computed using the same logic, all right? Did you guys get something that kind of looks like that? And notice that I put a proper title on it of the company name, the type of the budget, and the time period, okay? Now, they asked us to do quarterly totals on this, didn't they? Let's look at those quarterly totals. You have to be a little careful here, okay? When you're doing for the quarter is April 1st through June 30th. Yes, we can add those up to get 215. However, when we do the number for ending inventory for the quarter, we do not add these three numbers up, and I want to make sure you understand why. Okay? If we are looking at the period of April 1st through June 30th, then the ending inventory will be the ending inventory of June. It's not the beginning, it's not the sum of these three numbers. Does that make sense? Okay? Then we go down here, and it's the same with the beginning inventory. We do not sum these three numbers. The beginning inventory of the quarter, as defined by this, is the beginning inventory of April, which is 5,000. Okay? And then that foots down to this. You got to make sure that this logically and mathematically makes sense. 215 plus 8 equals 223, minus 5 equals 218. All right? So you got to be careful a little bit when you do your totals. You can't just foot everything across or add everything up from that's on the left. Okay? Questions on that, folks? All righty. I think we have one more, don't we? And that was this one. Separate situation. Okay. Sarandon Company reports the following sales forecast. Okay. May 99,000, June 72,000, July 89,000, and August 61,000. All sales are on account. Collection of credit sales are estimated to be received as follows: 30% in the month of sale, 45% in the first month after sale, 23% in the second month after sale, and 2% is estimated to be never collected, okay? Prepare a schedule of cash receipts for August in good form. Okay, now, once again, I kind of use this rationale of that follows this, okay? Okay, I say, okay, this is June sales. 30% will be collected in June, 45% in July, and 23% will be collected in August. July sales, 30% will be collected in July, 45% in August, and 23% in September. August sales, 30% will be collected in August, 45% in September, 23% in October. And then they're asking us to do a schedule of cash receipts for August, right? August, August, August. So what are we going to receive in August? Well, I highlighted it in yellow. We're going to receive 23% of June sales of $72,000, 45% of July sales of $89,000, and 30% of August sales of $61,000. And that equals these three numbers. And when you add these three numbers up, you get $74,910. Did anybody get that number? Okay. Now that's not a budget right there. Okay, that's not a budget. That kind of helps us create the budget. Now the budget might look something like this. Okay. Strand and Company budgeted cash receipts for the month ended August 31st. And you can see it right there. Pretty self-explanatory. These numbers came off of, see if I can show both of these at the same time. 23% of June sales, so on. Okay? Does that make sense? All right. Okay. Any questions on that, folks? Any questions? Okay, what we are going to do now is we're going to work on a couple quick studies here in class. All right, so they're going to play that music. And what I want to work on is Quick Study 2214 and Quick Study 2216. Okay? Let me show those. Okay? Quick Study 2214. Let me get these little stickers. Quick Study 2214, Quick Study 2216. Okay? They're going to play that music. And you folks at home, I want you to work on that as well. Okay? And we will go over that here in a few minutes. So I will blow that up if you forgot to bring your book. But do those two quick studies noted, and we will go over them in a little bit. All right, as always, folks, if you're not done at home, just push pause and start us up when you are ready. Let's go over, I'm not going to read them because you just read them, okay? So let's take a look at Quick Study 2214. Anybody get an answer? What was your total?
158,000.
158,000, okay? All right, let's take a look. There's how that's how theirs looked. You know, yours might look a little bit different, okay? But it should, you know, be similar. You know, you should have a number of 158,000 as the total cash receipts, okay? But that 68,000 cash receipts from September cash sales, and then you collect the prior month's receivables, right? So a lot of these are just kind of thinking through them, okay? Does this make sense? Okay? All right. Let's take a look at the answer to Quick Study 2216. All right? What'd you get as your answer? 630,000. 630? Uh-huh. Well, good. That's what they got. Okay, so let's take a look at that. Quick Study 2216. This is kind of using some of the same rationale, except it's in regards to disbursements, right? Okay, it's payments. All right, the cash disbursements for September purchases would be 180,000, which is 25% of that 720,000. And the cash disbursements for August purchases would be 75% of the 600,000 for 450. Total cash disbursements of 630, right? Okay? I think pretty straightforward. All right. Any questions on that? Okay. What I want to do now, I want to make sure, I'm not sure how much time we're going to have, so let me go ahead and I want you to look at exercise 22.1, okay? I'm going to put that on there while I read it. And we're going to actually kind of work through this in class because I found over the years that it seems like students kind of need a little hand in getting started on this, okay? So we're going to work on this one right here, all right? Let's go ahead and read that, all right? Okay, Kayak Company budgeted the following cash receipts, excluding cash receipts from loans received, and cash disbursements, excluding cash disbursements for loan and interest payments for the first 3 months of the next year, okay? All right, and you can see for January, February, March, the cash receipts and the cash disbursements that are budgeted. Now look down below here. According to a credit agreement with the company's bank, Kayak promises to have a minimum cash balance of $30,000 at month end. In return, the bank has agreed that the company can borrow up to $150,000 at an annual interest rate of 12% paid on the last day of each month. The interest is computed based on the beginning balance of the loan for the month. The company has a cash balance of $30,000 and a loan balance of $60,000 at January 1st. Prepare monthly cash budgets for each of the first 3 months of next year. Okay, come off that. First of all, we have a situation here where the bank has said, okay, you need to have at least $30,000 in your account. Now, if you don't have that, we'll loan it to you, but you need to have at least $30,000 in your checking account. That's the agreement we have with the bank. Now, why would the bank require that? Let's think about this.
Defaulted or something?
Well, here's the deal.
Security for them?
It's close, but it's not quite. Here's the problem with that. Let's say you don't have 30,000. Let's say you only have 5. Well, if they're afraid of default, then they loan you more money to bring you up to 30,000. You see what I'm saying? Yeah. That doesn't make sense. So why does the bank have this requirement with Kayak? You're thinking along the right lines, but this is a little different.
They use the money for the things that the bank does for loans and to gain interest other ways.
Well, and some people say because they want to have interest. Well, again, if they are low on cash, I I'm not sure your first thought would be, let's loan them more money so we can get more interest. I think you guys are in the same, or are in the right ballpark, but let me crystallize this. The bank is saying this, hey look, we want you to be a long-time customer, and we do want you to repay your loans, and yes, we would enjoy making interest off those loans. But we recognize that you need to have cash in the bank for operations. If you run out of cash for operations, you are not going to be in business very long. Okay? This is not unlike when if you're off out of town for college and your dad says, hey, do you have any money right now? And you say, I don't have any money. Well, your dad knows that you need money to operate, to buy groceries and pay your rent. So he might loan you some because it's in his best interests for you to be able to survive. So someday you can pay for his retirement home, right? And you'll buy a nice one. Well, the bank has a vested interest in you being able to operate a kayak company. Does this make sense? So they're saying you need to have at least $30,000 so you can pay your salaries and pay your vendors. If you don't have it, we'll loan it to you at an annual interest rate of 12%. You with me? Okay. Now the annual interest rate is 12%, but we pay interest monthly. So what is the monthly interest rate? It's 1%. Okay? So I want to walk you through the first month of January and see how we're going to do this. Okay? All right. Let's switch over to Excel. Okay? Let's see if I can blow that up a little bit. Okay? Okay, first of all, this is Kayak Company. We're doing a cash budget for January, February, and March. Okay? I'm not going to let that take up precious screen, though, so I'm going to scroll past that. Are you with me? Okay. So in January, what is our beginning cash balance? They tell us. How much? What's our beginning cash balance?
$30,000.
Yeah.
$30,000, right? Okay. You follow me? Okay, what are our cash receipts for January? They tell us this too. $525,000. This is all given, right? So the total cash available is $555,000. And you can see that this budget is already starting to take the form of the beginning of something plus what comes in minus what goes out equals the end. Okay? So we have our beginning cash balance of 30, cash receipts of 525, and that gives us total cash available of 555. Now, what are our cash disbursements for January? What amount? Look in your book.
$475,000.
$475,000. Cool? Okay, now that is all your cash disbursements except for one. It does not include interest expense. We need to calculate interest expense. Are you with me? Interest expense is going to be, what did I say the monthly interest rate was?
1%.
It was 1%. What is our beginning? We calculate interest based on the loan balance at the beginning of the month. What was the loan balance at the beginning of this month?
60,000.
Was it 60,000? I think you're right. So interest would be $600. Is that correct? You with me? So now what we are going to do is we are going to figure out our preliminary cash balance. And by the way, leave a couple blank lines here, okay? Because you'll need them when you do the other months. So leave a little space between where you wrote January and where you write preliminary cash balance, okay? The preliminary cash balance is thus $555,000 minus our disbursements of $475,000 minus our payment of $600. We have a preliminary cash balance of $79,400. Are you with me? Everybody following me so far?
You subtracted. I looked down for a second. Did
That's
you
all right.
subtract cash disbursements?
This is 555 minus 475 minus 600 equals 79.4. Okay? Okay, now let me let me highlight this right here because it is at this point that we need to have a little discussion with ourselves. The first question we ask is, do we have at least $30,000 as the bank requires? Take a look at the screen. Do we have at least $30,000? Yes, we do. Okay, that's good. We don't have to borrow anything. My second question is can we afford to pay back some of the loan outstanding that we have? Yes, we can. How much do we owe? We owe $60,000, right? How much of that loan can we pay back, but it won't take our cash below the required amount of $30,000? We can pay back, we owe $60,000. We can pay back $49,400. Is that correct? Yeah. Okay, and again, leave some lines here if you would. Okay, you'll need them for the other months. Okay, this gives us an ending cash balance, sure enough, of $30,000. You with me? Okay. Any questions thus far? Okay. Now, the other thing that I want to do is I want to say, what is our ending loan balance at the end of January at this point? Does anybody know what it is? Now, you don't get it by footing this column down, okay? So sometimes I will draw a line to separate this so that, because this is kind of a separate item, okay? You are right. It is 10,600. Okay, and how did you get that?
60,000 minus the 49.
You took the 60,000 right here, minus the 49,400 that we paid off. Is that correct? Mm-hmm. All right. Good, and that gives us 10,600. So that is the budgeted cash, or the cash budget for Kayak for January, okay? Now, part of your homework will be this, is to figure out what February and March's is, okay? What February and March's is. All right, any questions on that? So part of your homework will be to finish up exercise 22-1. Well, because you might have to put February, taking a look at it. You might have to put February interest expense. You might have to put March interest expense. And you may have to borrow a loan, so you want to have room for those possible explanations without it getting messy. Okay? Does that make sense?
Yeah.
Okay? Okay, let's go ahead and call it a day. All right? We got a few minutes, but I'll let you go. I don't think we have time to do another one in class. So here's what I'd like you to do for homework. All right? Okay. Okay, I want you to finish exercise 22-1. Okay, that's the one we just started on. I want you to do quick study 22-5. And I also want you to do, well, let's see. Let's just do that, okay? Not a very long homework assignment, so make sure you do it. Finish exercise 22-1. And I said that wrong. Finish exercise 22-1 and do quick study 22-5. Did I say that right? Okay, any questions, folks? All right, you learn this stuff by doing it. We're getting towards the end, folks. We don't have many left. So do your homework. We'll get back next time. We'll work on some more stuff in class. Okay? See you guys later.